If your assets are held in your personal name, they are fully exposed to the UK inheritance tax. Even if those assets sit outside the UK, they can still be included in your estate depending on your domicile position. At the point of succession, this can result in tax of up to 40%, combined with probate delays and restricted access to funds when they are needed the most. Because of this, many international families focus on restructuring ownership rather than relocating assets. The structure determines how assets are treated, not just the jurisdiction. My name is Shiraz Faeed and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain how offshore bonds are used in practice, how they can help legally reduce the UK inheritance tax exposure when structured correctly, and how they interact with domicile and tax rules, as well as where they fit within a broader cross-border wealth structure. An offshore bond is an insurance-based investment wrapper issued by a regulated life insurance company, commonly in jurisdictions such as Ireland, Luxembourg, or Isles of Man. Inside the policy, you can hold funds, equities, or discretionary portfolios. The insurer owns the underlying assets and you hold the policy. This shifts the legal position from direct ownership to contractual rights under the policy, which allows the structure to be arranged more flexibly. The bond itself remains an asset and its treatment depends on how it is structured, who owns it, and how it fits within your wider estate plan. UK inheritance tax is primarily driven by domicile, but residency has increasingly become relevant through the 10 out of 20 years rule. If you have been a UK resident for at least 10 out of the last 20 tax years, you may be treated as deemed domicile, which brings your global assets within the scope of inheritance tax, including those held overseas. When you hold investments personally, they are fully included in your estate and assessed together at death. For international families, this creates a structural issue where assets are diversified based on geography, but tax exposure remains consolidated, often combined with probate delays. Now, for these reasons, offshore bonds can create a platform that can be structured differently from direct ownership. The most common use of an offshore bond is inheritance planning through assignment or placement into a trust or similar structure. When a bond is assigned into a trust, ownership shifts from you to the trustee, and the bond continues with a separate legal framework. Over time, this can reduce the value of your personal estate depending on how the transfer is structured and how long you survive after making it. In UK tax terms, this is often linked to a potentially exempt transfer, where if you survive 7 years from the date of transfer, the value may fall outside of your estate. The outcome depends on timing, intention, and proper structuring, as retaining control incorrectly or weak governance can affect the treatment. Trustees must act independently and the structure must operate in line with legal requirements. In many cases, the offshore bond sits within a wider structure such as a trust or foundation. A trust separates legal ownership from beneficial ownership, allowing trustees to manage assets while beneficiaries receive the value under a defined term. A foundation, particularly in DIFC or ADGM, provides a similar outcome through a standalone legal entity with its own governance framework. Combining these structures allow you to define how assets are managed, how distributions are made, and how control continues beyond your lifetime. Financial institutions also tend to respond more positively to structured ownership, supporting stability in long-term management. Offshore bonds also provide tax deferral. Investments within the bond can typically grow without immediate taxation on income or gains, with tax applied when withdrawals are made depending on your residency at the time. For internationally mobile individuals and families, this creates flexibility in aligning withdrawals with favorable tax positions. However, tax is not removed, and outcome depends on residency and jurisdictional rules. This makes it important to align the bond with your broader tax position and future planning rather than viewing it in isolation. From a practical perspective, offshore bonds simplify administration by consolidating investments within a single policy rather than multiple accounts. This makes reporting and ongoing management more efficient, particularly when combined with trusts or foundations. Financial institutions are generally more comfortable with regulated wrappers issued by established insurers, which supports continuity. The choice of provider remains important, as jurisdiction, regulation, and financial strength all influence long-term performance. Offshore bonds are not suitable in every situation. Without proper structuring, they may remain within your estate and provide limited benefits. Transfers without planning can trigger tax consequences, and retaining too much control may weaken the structure. Costs such as insurance fee, administration, and advisory must also be considered. The effectiveness of bond depends on how well it is integrated into the broader strategy involving trust, foundations, and coordinated cross-border planning. For international families, offshore bonds are one layer within a wider structure that may include operating companies, SPVs, governance frameworks such as trust or foundations. The bond acts as an investment wrapper within the structure and can be assigned or managed accordingly. This layered approach improves continuity, separates personal ownership from control, and creates a framework that continues beyond your lifetime. Each layer must be aligned across legal, tax, and banking considerations to ensure the structure functions effectively across all jurisdictions. Now, if you want our help and would like to explore how an offshore bond, trust, or foundations can be structured to help you reduce inheritance tax exposure legally, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.